Let's face it, everybody, Americans right now are facing higher mortgage rates, unaffordable home prices. A record number of home buyers are now walking away from their deals. Mortgage lenders are starting to go broke. The question is the real estate market doomed? Welcome back to the channel. My name is Matthew Pillmore. In today's video, we're going to be looking at several signifiers within the housing market once again, what they mean for home buyers and investors like yourselves, whether a crash is imminent or not, and what exactly you can do about it to position yourself to profit in the coming months to years, regardless of what does actually end up happening. Today, I'm going to be joined again by Michael Matthew, who's been deeply involved in the real estate market for the past decade and a half, and thus has a lot of expertise to thereby share with all of us here today. Michael, looking forward to talking through these numbers with you and getting your impression of how things are really looking out there and where we're headed and exactly what one can be doing to make money. So let's go ahead and dive into some of the numbers, Michael. Obviously, the increase of interest rates has been having a real major impact on the real estate market, with those interest rates pushing would-be home buyers out of the consumer's price range. And this has been leading into more home buyers walking away from deals. According to a new report recently by Redfin, roughly 63,000 home buyers fell out of their deals through July of this year, and that accounted for 16.1% of the homes that were under contract during that month. That is crazy. That's marking the highest proportion ever, except for March and April of 2020 when the pandemic first hit, when coronavirus shook up the market then. Highest rates of cancellation have been in Jacksonville, Florida, here in sort of my second home territory and where you do a lot of work also, as well as Las Vegas, Nevada. In July, around 800 home buying agreements were actually canceled in Jacksonville, which represented almost 30%, 29.3% of homes that were under contract that month. In Las Vegas, 27.4% of the home purchase agreements were actually pulled. And that certainly looks bad, of course, for those areas. But with the decline in competition, some home hunters still in the market are actually enjoying sort of this newfound buying power. And that's a sharp contrast really to last year at this time when sellers were being flooded with offers. Many were much above the asking price. And with this cool down, buyers are starting to ask for repairs again, closing concessions, deferments. They're backing off and moving on when sellers say no and start kicking back on things. So the market seems to be shifting. And as the market starts to slow nationwide, sellers are really beginning to adjust their expectations once again. Homes that might have received dozens of offers earlier in the year are getting only maybe a handful now. Other properties are receiving maybe no offers, and they're forcing the owners to either ask for less or just take the property off the market and I would say at a bare minimum give up these dreams of record profits like we've never seen before. Some potential sellers are really calling it quits, as I said. I mean, properties are just being pulled off. Some owners are really only wanting to sell if they can really command a specific price. No big surprise, obviously. I think sellers can be a bit irrational at times, and it has become difficult right now in a market that's being pulled down by these rising interest rates. Others, let's say, have a mortgage at 3% or less, which is where interest rates were in the past, and they just don't want to leave that behind in order to borrow again at 5%. I've been contemplating already selling the condo that I purchased here in Florida in December, and I have such a terrific interest rate on that property that it is making it a bit more complex to then sell it and look to trade across for a single family, which would actually give me a bit more of what I'm looking for from the asset standpoint. But with fears of a recession that are starting to mount, there's really hesitancy across the board, which I think comes with any economic uncertainty. And these decisions are effectively capping the rate at which inventory can rise. And that seems to have these broad implications for both existing homeowners and prospective buyers. And that's because when less homes are available, it obviously prevents prices from plunging And it just goes back to economics 101 with supply and demand. Going back to data from Redfin again, it shows that in the 4 weeks ending on August 7th, just a few weeks ago, total homes listed for sale nationwide were almost 4% higher than the same time last year. And that increase is mostly due to homes coming onto the market and they're just taking longer to sell. The turn times have extended at this point, and days on market we're seeing increase. And over that same time frame, first-time home buyers have also declined by almost 12%. A huge portion of the marketplace, of course, coming from the first-time home buyership that are now being priced out. New build numbers aren't looking great either. Talked a little bit about this on a recent video. Number of new starts on homes actually fell sharply in July. Single family starts fell 10% compared to the previous month. Huge drop off. That hit the lowest level since June of 2020, which was obviously a very uncertain time during the pandemic. So Michael, I guess what I'm wondering is, what do you make of these numbers? It looks like the housing market is in a tough position right now, with neither buyers nor sellers finding themselves in a real positive position. And that's kind of unique. We're sort of in this purgatory space. So what solution really is out there, if any, for people who are, going into the housing market right now, whether as a buyer or a seller?
Yeah, so I think it's really interesting, and you touched on a lot of really cool data points on there that we'll just kind of unpack this here as the video goes. So it is kind of a unique situation where it's just been that massive seller market here for the last couple of years, and buyers have literally been at the whim of a seller. Contingencies were a thing of the past. Days on market were 24 hours or less. People were paying 20% over list within 24 hours. I mean, it was the Wild West. So now it's starting to get back down to normal. We've talked, on this video series here for years about the market corrections. We all anticipated that happening a couple of years ago for a number of reasons. It didn't. Here we are today. It is starting to soften. However, buyers, depends on whether or not they're going to be an owner occupant as a homeowner, or whether or not they're looking at it kind of through that investor lens. So if I'm looking at it as an investor, interest rates are fairly irrelevant to me, and there's a number of reasons for that. But if I'm an owner occupant and I'm looking out to buy a home for me and my family, then of course interest rates are going to be certainly on my radar. Your illustration there is if they've got a 3% rate, the willingness for them to go out there and take on a 5.5% mortgage obviously doesn't it's not super enticing to them. But that being said, people are always going to have to want, or they're always going to need to sell and buy real estate. That's not going away, period. So I think what's important right now from an investor standpoint is get into the house. If there's meat on the bone still, even with high interest rates, the goal for most investors right now is to get in the deal if there's meat on the bone, with the intent to do a refinance when the math makes sense, and then 100% of that savings will convert to, positive net monthly cash flow. So that would be the investor play.
I mean, I obviously agree that creative real estate is really going to be crucial in the coming months and years. I do think it's important, if people haven't already checked out the videos that we've done surrounding Little Pink Houses of America, your company, that they do so. It's a great way, of course, to explore sort of this Swiss Army knife of opportunity within real estate that's not isolated to things that might only produce those really small chunks of meat on the bone, like a very limited low single digit hundreds of dollars per month in net cash flow from what would be considered at least a double or triple single family res type of long-term buy and hold landlording property at this point. Getting into that 500 and up dollar per month net cash flow position, I think, is going to become increasingly more difficult with interest rates the way they are, purchase prices where they're at, and of course ongoing investor competition of people who have been really active over the last 12 years that suddenly aren't able to really dive in as much now because there's just fewer and fewer homes that will produce. And yet you've got these short-term rentals that are facing the same process. And I always look at short-term rentals with a safety net in mind and an exit strategy, because what happens if the market turns and we see prices dip? You don't want to turn around and sell and lose, so you might end up with a long-term rental by accident versus a short-term rental by design. If an ordinance is suddenly in place and you're looking at what the long-term backup plan would be, and a tenant just doesn't produce enough in rental income for you to cash flow, and now you're out of pocket every single month just waiting for the market to recover. That's not a really appealing strategy either. So you've got to sort of have these sort of out of the box creative ways of getting a hold of the opportunities that are going to be there. I love that. So let's go ahead and just give the email to people that are interested in reaching out to find out more about the Pink Houses opportunity. That is pink, like the color, at VIPfinancialeducation.com, which is the full company name of this YouTube channel, VIPfinancialeducation.com. Pink at VIPfinancialeducation.com will be in the description for you guys below. But make sure you watch the videos down there too, because we are going to go ahead and answer a lot of the questions that you might have about that opportunity. I just think it's becoming, again, one of the most spectacular ways of diversifying your ability to make money in this market. But like I was saying, I mean, creative real estate is going to be crucial in coming months to years. And if you don't want to be sidelined, I mean, if you look back at the fact that we're seeing the worst housing affordability since 1989, according to the National Association of Realtors, the average existing single family sales price was $423,300 in June. And the median mortgage interest rate at that time was 5.6%. And a median household income at that point, combined joint income, median household income of $91,952, so just shy of $92K. In June of 1989, median existing single family prices were at $94,800 in contrast. Mortgage rates were actually 10.6% versus 5.5%, and the median household income was just $34,128 according to NAR. So that means that the current average existing single family sales price is 4.6 times the current median household income, while it was 2.8 times the median household income in 1989. But when you factor in the difference of mortgage rates, the average home in 1989 cost approximately 30.7% of the median household income. But June of this year, it was 31.7%. Very similar across the board, due to the fact that there was a 5% higher average interest rate in 1989. And that's how much of a difference that extra 5% can make in your costs of a property. And much of that, obviously, a much higher percentage of that going towards interest every single month. Unfortunately, it does appear that the Fed is going to continue to push those interest rates higher, it sounds like. They're looking to curb inflation. Powell's been super upfront about that. So affordability actually might take an even bigger hit in coming months. It'll be interesting to see how this thing shakes out based on the prices coming down and rates going up. Will it sort of even out across the board, or are we going to see prices sort of hold flat or continue to rise just at slower amounts? But the Fed did see little evidence last month that U.S. inflation pressures were easing, which indicates that they're likely going to continue to approve these additional hikes. But given the need to take time to assess how the more restrictive policies are really affecting the economy. Some are saying it would be appropriate at some point to shift away from the larger 75-point increases. But final level of rates is still kind of seems to be unclear. Have you heard anything different than that?
No, and I'm reading a lot of that same stuff. There was those astronomical rates, obviously, within the last handful of months for good reason. I thought it was too little, too late. I went on record on multiple videos saying that. We got up to 9.1%. Recently, we've dropped down into that, I think, around 8.5% inflation. But now we've got, this new legislation being passed by the Biden administration, which is effectively dumping another $1 trillion into the economy. I think it's called the IRS Acceleration Act. Is that the name of the bill, or is it the Inflation Reduction Act? I mean, ultimately what they're doing is putting 86,000 more IRS workers kind of on the case. So interesting to see what goes on with that. You kind of hit the nail on the head with why this is a great time for Pink. This really is the perfect storm. So with tough banking restrictions, with higher interest rates right there, it's tough for John Q and Jane Q homeowner to walk into a Chase Bank or a Wells Fargo and get that traditional financing today for those exact reasons, or they don't want to go in and they don't want to lock in that high rate. the sellers are kind of suffering right now, even though we're not at the inventory we need. Those buyers that are not now in their pool of buyers for that particular house are obviously affecting and hurting the sale of their home, which is effectively causing price reductions. That's the only way that they're able to sell it. With the PINK model, the benefit for the seller is we're bringing buyers in that can't qualify for traditional financing today. They make good money. They've got good, stable jobs, a lot of self-employed. That's a huge demographic of buyer for us. Everyone that's watching this knows someone that makes money but can't walk into the bank. They've got good character. They can afford the monthly mortgage payments, but they would get denied. So what we do is provide them with a platform to purchase a house through Pink Houses of America. Then working with sellers that they want to sell their house right now, they don't want to have a million price reductions. They still want to get at the top of the market as far as value goes, even though they really did. I mean, in all honesty, they missed the mark. People that were, kind of waiting to see over the last handful of months how high their price value got. They didn't pull the trigger. Now they wish they did. Well, they still may want to sell their house and they still want to capitalize on really the high end of the sale of that house. So we can bring a buyer in, we plug them into that house. They're making payments for a period of time to that seller. They're paying top market value. So sellers really maximizing the sale of the home. And the buyer is not having to go to the bank today. We're working with them to help them get mortgage ready, mortgage qualified in a 12 to 24 month window of time while they're living in that house. And the advantage in that time is that in 12 or 24 months from now, we hope that rates have gone back down a little bit. So when they do go to get their permanent financing, they're locking in something closer to that 3% range, hopefully. So it is a perfect storm for that. But we have built the perfect kind of safety net for both buyer and seller to really capitalize on the market. That's what's exciting for us. And that's what's exciting for our affiliates that we're working with across the country.
Yeah, because obviously I think there is so much unpredictability of what's exactly going to happen next. Obviously, there's ways of using data points that we're discussing here today in order to make some predictions and anticipate what the market might do. But in the meantime, nobody really wants to be completely sidelined and not be able to get out there and remain active in order to generate additional revenues and continue to contribute positively to their net worth. And I think that's where Pink comes in. You recently had brought up a deal, I think the other, shortly after I returned from Colombia, and I believe you even mentioned it to me while I was out on that trip, where a mutual client of ours had recently converted on a deal that had been underway for a couple of years now and was able to pull nearly 6 figures from that. Can you expand on that for us a little bit?
Yeah, 100%. So again, we do call ourselves that Swiss Army knife approach. So I don't care if you're in Los Angeles, Kansas City, Missouri, Miami, Florida, you're going to see deals come across your desk. And we've got the ability. What's important right now is working with people that have the ability to recognize a deal once they have figured out where to find them, first and foremost. I mean, you have to know where to find the deals in any market. That's what Pink provides, is that lead generation service where we're locking arms with you. We're attacking your market. We're uncovering these deals. Then we're helping you take them down. So a deal that I really love, and we've done videos on it before, is called a subject to, a sub two. Basically, that means you are buying the house as an investor. And this is a no cash strategy, which we love and we talk about often, that executive lease purchase being another one of them. But with the sub two, they're buying the house subject to the underlying mortgage staying in place. So a seller likes that because effectively all they're looking for is debt service. So we found a seller that had a pretty good amount of equity in the house. They needed to sell it. They needed to get out from underneath the debt. All they cared about was not having that monthly payment. We found the deal, uncovered the deal, realized that that was really kind of the pressure or the pain point for that seller. And based on that, we knew that we could structure a deal that not only benefited them, but then benefited our affiliate seller there, or our affiliate buyer for Pink in that market. So we put the house under contract. There were some closing costs right around $6,000. Now this was a couple years ago, and with a sub two, you are making that net positive cash flow each month on the property. But the big deal is that you're getting that equity over time without being on the hook for the mortgage. So fast forward the tape 2 years to today. and they are cashing out right now. And I believe, and I don't have the exact number, I believe it's just shy of $200,000 on a deal that cost them $6,000 to get into, 2 years ago. So with Pink, you do have those kind of instant gratification deals, the executive lease purchase, which is what we were really founded on. That really brought us to the dance. That's a no cash, no credit deal. I gave the illustration on how that works with the buyer and the seller. Obviously, Pink's got all the mechanics in the middle that we're working with our affiliates across the country on getting these deals across the finish line, which is really what we provide, is that ongoing coaching, training, and support to make sure that each one of these deals is done correctly, they're done legally, and they are brought across that finish line, which is where the rubber ultimately meets the road. So we were thrilled for our affiliate. They did have to wait 2 years, but I'll wait 2 years to get $200,000 back on a $6,000 investment. Would you?
I mean, it's phenomenal. And I guess I admittedly, a lot of it still kind of goes over my head in spite of having been around the industry for quite a while. And I'm assuming that there's going to be that situation for a number of people who are sitting here watching today. So, forgive those of us that don't necessarily follow everything you're saying. But a couple of things that I do want to highlight have stood out to me regarding the Pink model for this many years of discussing it here on the channel and having a bit of an understanding of what somebody could expect if they too became an affiliate. There are pros and cons to absolutely everything that involves being in business for yourself. If you want to work for yourself, it's going to take hard work. Everybody, I think, is becoming more and more transparent about that in the space of discussing entrepreneurship. I appreciate that, but I still think that some want to be entrepreneurs come in overly optimistic about what their contribution to that effort is going to need to would need to require. In your case, I think it's important to point out what type of workload is necessary to do to be effective in this space. I've heard it over and over and over again from your mouth directly, as well as people that we share as far as mutual clients, that you got to be prepared to invest anywhere between 15 hours and up to do well with this business. But if you did, the very realistic possibility of generating six figures in revenues annually on average exists, and even as high as several $100,000. That's part-time work for several $100,000 potential. I definitely would suggest that all day long to people who are trying to level their way up through some form of a side hustle. I prefer calling it a side empire, because I'm not sure why you would treat your day job where you're making $75,000 or even $100,000 or even $150,000 as seriously as putting in 40, 50, 60 hours a week, along with potentially a commute, as well as potentially expectations from your employer that are very restrictive, and you're working to make someone else wealthy versus putting in half of that amount of time to make the same or more money, being able to work from home and essentially create your own lifestyle and your own schedule. That to me is, I don't know why we would call that a side hustle. I would rather treat that as if it's the more important of the two, personally, until you're able to transition away from the day job, so to speak. With that, I think that it's important to mention that it's not inexpensive to work with Pink. Pink does charge an affiliate fee. They've got 2 different membership options from what I remember. So I want to make sure I'm advocating here for my audience that this is something that they would need to expect, but you do have financing options. You've got ways for people to get in with little and even in some cases no money out of their own pocket. We've had some of our mutual clients use debt weapons in the past to get involved, even debt weapons like a home equity line of credit. I recently used a home equity line of credit to start my own side empire, and that is, in the first year, it already locked down $165,000 in revenue. This year, we're already on pace to generate over $300,000 in revenue. So this is the exact same strategy that I took with no money out of my pocket, because I relied on that specific debt weapon tool. Something to consider if you're looking at something with Pink as well. I also love that you guys are there to hold everybody's hand. I think far too often you get these sort of over promises and under deliveries of businesses in a box, where you're just sort of there fumbling through it on your own. You may as well just go out and try and start something by yourself. The idea of buying into this sort of franchise-esque model is that it's a blueprint that's pre-existing waiting for you. And I love that you guys really take people by the hand. You're there working with them one-on-one. We've got countless testimonials. They come in all the time. We just don't always publish them on the channel here, but we've got a lot of videos you can check out in the description of people that are doing extraordinarily well, that really had no experience. In some cases, maybe a little bit, but a lot of folks just come in completely green, and you're able to take them step by step, A to Z, in order to get them to a closing table like the one you just discussed. Not everybody's going to make $200,000. Obviously, results do vary, but it's because of your hand holding that got to the closing table. I was definitely a receptive ear to that as it unfolded because we had a mutual client involved. And there were times where he was frustrated and he felt like he wasn't going to end up getting there. And lo and behold, here we are 2 years later with, a couple $100,000 there. And I guess the last thing that sort of stands out to me, good, bad, or ugly, is the win-win-win factor of this. Obviously, you guys as a company need to be getting paid. You put in a ton of effort along with the legalities of it, along with the scripting of it, along with the support, along with the lead gen. All of that is extremely expensive to provide, but you're then providing this amazing blueprint that people can realistically earn significant amounts of money for, working part-time hours from home with little or no money out of pocket. And then in addition to that, the sellers that you're helping are going to win. The people that are on the other end of the transaction, the people that you just sold that house for, are also going to be extremely excited about the outcome. So I've always loved that type of a business model or transaction framework is where everybody is coming out on top. So I think it all boils down to ROI. If you're not going to do the work, you shouldn't be signing up. This is definitely not a model that is for most people. For those of you that are still curious, definitely email pink@vipfinancialeducation.com. You can throw your name, first and last, as well as contact phone number in the body of that email. Put conversation in the subject line so that Michael and his team knows that they can reach out. One final thing that I do want to praise you guys about, because I do scrutinize this, and I'm a skeptic. As much as I love you and we have a great friendship and we work together on many different capacities, this is not something where I'm going to favor you before the audience. The audience at this point knows that this is an advocated channel for them and their well-being. And I've always loved that you don't hard sell people. This is not something where you're strong arming and people feel like they've been convinced to do something they shouldn't be doing. If you notice that somebody is not a great personality fit for your model, I've seen you turn away people left, right, and center, because this is just, it's of no benefit to you if they don't succeed also. This upfront cost of participation is a loss leader for pink houses, and it's really more of the transactional success where everybody ends up winning, where it's going to end up benefiting them. So Michael, I just want to kind of sing your praises about that as well, that as far as a sales process is concerned, you guys are bar none, just like VIP is, doing it the right way. And I really do appreciate you for that. And on our audience's behalf, I do say thank you for that.
Yeah, no, I appreciate that. I really do. At this point in my career, and you said something that really hits home for me and our team at Pink, is that win-win-win. That's important. Money is not my driver anymore. What my personal and professional driver is to create scenarios and build businesses that A, solve a problem, right? And then B, everyone involved in it can kind of get their pound of flesh, if you will, which is just so rare, especially in real estate investing. It's such a dog-eat-dog world where what we're doing is creating businesses that can accomplish a lot of goals and do a lot of good things for folks. But you can do business the right way. You can look at yourself in the mirror. You can feel proud of what you're doing. Talk to your friends and family about it. There's nothing to be ashamed of. And that's how I like to start every day, knowing that yesterday I did right by everyone I talked to, right? So with this, we present an opportunity, and it's a great one. And there is a cost up front with it, but the deals are very lucrative. On average, our affiliates make about $15,000 per transaction. Obviously, we gave an illustration of an anomaly. Not everyone, and we certainly are not going to tell people that you're going to make $200,000 on a deal. But those deals do exist, right? So it's transactional. They're going to add up over time. Nothing wrong with singles and doubles. But to get your initial investment back, it can happen very quickly if you go do the work. This is not a passive investment strategy. We have touched on, passive strategies like Lavish Keys here on the channel recently. This is not that. This is for folks that want to either have it as a side hustle to supplement income to their W-2, ultimately transition out into this full time, or just keep it bolted on and they've got that extra amount of cash that they can make in that 15 to 20 hours a week. But just know that you're going to have to, get out of bed and do the work every day and put the time in. But we're giving you a blueprint. We're holding your hand. We're coaching you. You've got a dedicated day-to-day coach. We've got ongoing training and support. You're never going to wonder what you're supposed to be doing. And that's why people love this model. They're walking right into a very successful business in a box. And they are that entrepreneur. They do own their own business, but they are in business for themselves, but not by themselves because of that tremendous corporate support they get.
Yeah, and I guess I just can't stress enough, whether you're just going in to buy something for personal use right now, which might make sense still if it's completely affordable, or you're looking at still trying to find a way to carve out a profit margin as an investor right now. The importance of having the right team around you is everything when navigating a market, especially when the conditions are so different than they previously were. We talked a little bit before about affordability. I do want to dig into that a bit more because according to Realty Hop's affordability index, housing affordability is so dismal that in 42% of the cities on the index, an average American is going to need to devote at least 40% of their income to own a home. And that's why I love talking a little bit about these side empires and really how to crank up your cash flow. I mean, this channel is all about cash flow, folks, and the only way to increase cash flow is to make more and spend less. I personally am not somebody that likes to skimp when it comes to lifestyle. I personally don't want the beans and rice model that Dave Ramsey talks about. It's never been appealing to me and never will be appealing to me. And frankly, the people that reach out that I have communications with from here on this channel, they don't want it either. It's not the type of goal setting that we do. We're more abundance minded versus scarcity minded. So I'm going to find a way to make more money before I'm going to find a way to cut into my lifestyle spending. When it comes into reducing costs, I definitely want to continue to find a way to pay as little in interest as I possibly can. That means I'm going to follow the other techniques on this channel to do that. I'm going to find a way to pay as little in taxes as I possibly can. I'm going to find a way to pay as little in things like insurance or other unnecessary expenses as possible, but it's not going to be the lifestyle portion. But it does, things are really bad. I want to kind of talk about a couple of these areas. Places like Miami, Los Angeles, New York, where an average family looking to buy a home is going to need to dedicate over 80% of their annual income towards housing. It's unsustainable, totally unsustainable. And traditionally, Americans have really been advised to spend no more than 30% of their income on housing costs. This is where your debt to income ratio comes in. But things like debt to income ratio only factor what's showing up on your credit report. It's imported into the 1003. And essentially, there are a lot of expenses that aren't included inside that. Things like my HOA, for example, and the property I'm sitting in right now, my HOA costs $670 by itself. That doesn't show up against my debt to income ratio. So when you add in all the housing expenses, it really does easily crank up well above what a lender would tolerate to get you an approval. The figure was really popularized by the US government back in 1981. And it's really been widely accepted as sort of the norm ever since. And I think that's pretty interesting that it's been going on for this many decades, 4 decades now. Really anyone who's familiar with this channel is going to know that we really do take intelligence allocation of one's finances really seriously. And I've just got to say how disastrous it will be for folks to be putting such a high percentage of their income into their housing. So if you're looking at something for yourself personally and it's not truly an asset, again, this condominium I'm sitting in right now that I purchased in December for about $640,000 is now worth somewhere close to $800,000, if you can believe that, in just an 8 or 9 month period of time. Now I've done a little bit of work to it, but not enough to justify that type of price increase. I'm already looking at selling simply because even with a 20% down payment, the cost on this property with the HOA as high as it is comes out to almost $4,200 with utilities and so forth. It's even a little bit more than that. So looking at this as a primary or as a secondary property that I don't rent and don't make any money from, it's just very, very difficult for me to justify putting that type of money in when I want to do the traveling that I'm doing and I spend so much time in Colorado. So I'm personally in this position as well where I'm reconsidering how much I really want to commit to something for personal use versus something that can actually generate revenue as an asset. And that's going to be extremely important for you guys to differentiate how you want to be spending your hard-earned money right now. Make sure you're investing your money into assets like short-term net cash flow solutions, such as pink houses as a great way of making money, or long-term net worth investments, things like stocks, traditional retirement accounts, cryptocurrencies, and real estate investments. But certainly we want to find a way to offset that outflow of money in order to maintain the highest level of cash flow possible. And that really boils down to earning. But 40% is not good, guys. 80% is obviously downright insanity. This insanity with affordability is really driving a lot of families right now and individuals to decide whether it's even worth it or can they afford to stay where they are today. And I'm looking at potentially trying to take this $640,000 condo, sell it for $800,000 and potentially buy something as a single family in a less desirable area because I'm right on the beach. Maybe I can go a bit inland here in the Tampa area and buy something for $400,000 or $500,000 and carve off about a $300,000 cost to myself along with the HOA fees. But I just want to really quickly share 12 least affordable housing markets in the US. I think this is pretty interesting. I wanted to put this list together for today's conversation. The list also is going to maybe give some investors an idea as to where they may or may not be able to invest their money or maybe invest less or more depending on that specific market and whether that market could use a correction in the next 6 to say 24 months might be a great way to anticipate timing of their market as well. So coming in at number 12 is Boston, Massachusetts. It's got a median household income of $79,797. Median home price is $775,000, absolutely outrageous. And the housing share of income coming into 59.38%. Number 11 is Oakland, California, where homeowners will need to spend 60.85% of their income on housing. Number 10 is Santa Ana, California. That's a 62.14% of income going to housing. 9 is Anaheim, California, where 63.98% is going towards housing. Wouldn't you know it, another California city, San Diego, coming in at number 8, 65.65%. 7 is San Francisco with a median household income of $126,000, a median home price of $1.4 million, and 66.56% of income being forced to go towards housing. Number 6, guess where? That's right, California, folks. Long Beach, 69.77% of income going towards housing. And now we are here back on the east side, southeast anyway, in Hialeah, Florida. This is 72.55% of income going towards housing. Goodness gracious, how does anybody afford to live? Number 4 is Newark, New Jersey, 77.5% of income going towards housing. That's tough with gas prices and food costs the way they are today. Number 3 is New York. New York, median household income is $68,100 annually and a median home price of $925K. 82.47% of income would be required to go into housing. 82.47%. We've got Los Angeles coming in at number 2, 85.34%, and number 1 least affordable city in the entire United States is Miami, Florida. Median household income is just $44,581 and a median home price of $610K. with a whopping 87.39% of income going towards housing. Michael, these places tend to be very hot markets, which is why their prices are sky high. But obviously with residents needing to allocate over 60% of their income to their cost of housing, are these markets worth pursuing at this point for investors? And along with that, what kind of markets are you seeing the most potential in both short-term and long-term perspectives?
Yeah, I mean, no surprises on this list, and you were pointing them out. I mean, everything is going to be either right on the coast or close to the east or west coast. Obviously, was it Lanai or Hawaii that was in there? For obvious reasons, that's going to be expensive as well. So it's important to remember, we did a video on this recently as well. So you can look at these just astronomical housing prices there, but also know that if the market does kind of take a little bit of this dip, which we're kind of waiting to see what happens there, those coastal cities are going to be the ones that get hit the hardest, and they're going to get hit the first. So as an investor, I'm keeping an eye on those. Typically, I like to invest, if I'm coming in with cash, I like to invest in middle Americana. I like just, kind of the Midwestern states. I like to keep my cost basis low. If I'm an investor, I would rather, take $1 million and have, 5 to 8 houses as opposed to $1 million house, obviously, kind of spread the risk around as well and not have all my eggs in one basket. So, markets I love are like Ohio, Tennessee, I love Missouri, Wisconsin, Minnesota. Now, all those states all have some big cities in them. I tend to really gravitate more towards those rural areas. And just to kind of dovetail off that, like Pink, for example, we've got a new cash buying lead generation source that we've just rolled out within the last handful of months, which is really just it's a conveyor belt of these deals that are affiliates that want to have participation with, small kind of cap rates and, $50,000 to $100,000 investments, for example, some fractional investing. They're going to have access to look at those deals as well and have really, really healthy returns on them, which is important because most people just don't know where to find the right deals that have the right meat on the bones that are in those right markets. So Pink actually does provide that. But as a personal investor, I really like those kind of middle of the country states as opposed to the coastals. That being said, I don't discount any market. There's money to be made in every single market. I can guarantee you I could get dropped off in any of those and have a deal together inside of days, period. You just have to know where to look, how to identify those deals, ultimately how to break them down. And there's nuances involved with that. But none of those markets would scare me. My approach would be different. My exit strategy would certainly be different. My allocation of capital obviously would be much greater in those. But at the end of the day, if the deals pencil out, if there's money to be made, and just I'm a math guy, if the math works, I don't care if it's in Timbuktu or San Francisco or Irvine, California.
I saw, it's interesting. You brought up a couple points I'd love to kind of counter if you don't mind. You talked a little bit about putting all your eggs in one basket versus diversification. You talked about spreading things out. If you had $1 million, maybe buying 4 or 5 $250,000 homes versus buying a one or two $500,000 to $1 million property there. And it's interesting because I actually saw a post from our friend Patrick Bet-David recently quoting, I want to say it was Carnegie, and he said, "Put all your eggs in one basket and then just watch the basket." Right? And I guess I had this exact conversation with a coaching member today. It's funny it's coming up again because he said the same thing. He said he's talking to his long-term investor buddy who's believing the exact same philosophy as you. I said, let's play the devil's advocate here, play skeptic. I don't necessarily disagree, but are we talking about a diversification geographically? Is it because we're worried about one area being targeted over another when it comes to a possible decline of values? Is it because we're talking about if this one property sits vacant for for a few months, then it's a much bigger hit than if we have a handful of properties and only one of those is vacant. But I also wanted to at least just acknowledge that this is not as easy as saying it's black and white, always better to have more of less expensive versus one of more. If we had, for instance, 2 or 3 $350,000, $500,000 properties that were being short-term rented, and we were able to get an average nightly rate that was significantly higher than a handful of twice as many half-price properties, then it would seem to me that it would be better to take the more expensive property because it's going to take twice as much work. I do the same amount of work on one $500,000 property that somebody else does on one $200,000 property, and I may command $400 a night and they may command $75 a night. I think comparing side by side in that case makes a lot of sense. I also think that you have twice as many potential issues. You've got twice as many furnaces, roofs, toilets, and let's face it, tenants or guests, which means that the only issues I've ever had with landlording, Michael, have come from maintenance and tenants or guests. So I know that if I have twice as many of those things to worry about, I'll have twice as many issues. It's the same $1 million either way. I guess I just wasn't necessarily convinced that buying more of less expensive was better than buying fewer of more expensive. So I guess it would probably depend case by case in that situation. Furthermore, and just one last point, is you're talking about the coastlines, and we're obviously seeing that these are just scorching red hot markets, have been now for quite some time. And that's because they are desirable areas that oftentimes tend to pull the higher price tags when it comes to rental income and or short-term nightly rates. These are desirable areas that people like to visit. So if I'm buying a short-term rental, I realistically going to have to expect that I'm going to do better somewhere at the beach than somewhere in the middle of Nebraska. It just tends to work out that way. So I just wanted to those were ideas that had come to mind when you were chatting. I'm just curious if you had any reaction to that.
Yeah, no, that's spot on. And I probably should just clarify that a little bit better. If I'm looking at a long-term rental, for example, I'm going to be looking at it through that lens. If you're talking about short-term rentals, yeah, it's going to be, I'd rather have one monster $1 million house in Orlando, which is a market we love for short-term rentals, than obviously 10 $100,000 houses spread out across the country. Also, management should come into play. I mean, if you are looking at buying multiple long-term rentals, look at management. Take that headache off your plate. Short-term rentals, same thing. Look at management. Obviously, we've talked about Lavish Keys on here doing that white glove management services, but it's definitely going to be depending on the investment class, short-term versus long-term rentals, really what that exit strategy is going to look like. And that's going to really guide how I deploy capital. So I should have been a little bit more clear on that. We see that the exact same way, though. I would rather have one monster $1 million house than 10 $100,000 houses every single day of the week and twice on Sunday in that short-term rental space.
Fair enough. Fair enough. And that's kind of what I anticipated. Just wanted to make sure that people understood it makes sense to take the time to really lay these opportunities in front of you and try to make as close to comparisons as you're able. Even though you may be discussing apples and oranges, we're still probably discussing fruit. So I think it's important to make sure that we're analyzing these opportunities correctly in the months and years to come. But ultimately, again, I think it just really boils down to cash flow, making sure that you're looking for ways of really increasing your earnings potential while simultaneously constantly auditing the liability side of that balance sheet and making sure that you don't have any unnecessary leaks, taking that a step further and making sure that you're manipulating the way that your debts are being serviced, taking it a step further and then making sure that, of course, you're accelerating the way that your debts are being accelerated. You can pay those off in a fraction of the time, especially the non-mortgage related high interest type of consumer debts. And finally, of course, then applying any additional investing liquidity that you may have into opportunities that can have huge payoffs. Like I said, I've been successfully blessed enough to do that in a variety of different industries that have really allowed me to live whatever lifestyle I want, including 6 months of full-time RVing last year, including really 3 out of the last 4 months being able to take time away with my family during a tragic loss, and recently just being able to go to Colombia and do some networking and some business down there during a wedding event that I was invited to. So it's been truly a lifesaver for me, and I can't stress enough to people who are listening that you have that same opportunity in front of you. I'm no different than you. Michael's no different than you. We had to start somewhere. When we started, we were scared. When we started, we were overworked. And over time, with consistency, that effort began to pay off. And we were ultimately able to really streamline a lot of our processes and systems, and in order to really automate the way that money comes to us, to where price tags, whether we're being generous or whether we're being selfish, are no longer much of a factor at all. So that's really, I think the net outcome here is freedom of choice, how you're going to spend your time, how you choose to spend your money. And so you can live life on your terms, folks. These are cliche sayings for a reason. One last time on that email address, pink@vipfinancialeducation.com is where you'll reach out, put your first name, last name, and make sure you put your contact phone number in there. Be sure to check out the videos in the description. Those are going to answer a lot of your questions regarding what Michael was talking about here related to that business model. If you're still looking for a side hustle or side empire where you can really dominate spending that 15, 20 plus hours each week on something that's your own, where you can make hundreds of thousands, and there is a plethora, a collection of different ways of making money in there inside real estate during the toughest times, and really where we see things heading now, where things are going to continue to get a little bit trickier and more volatile over the next 6 to 24 months. Little Pink Houses of America is really going to be an option you're going to want to take a strong look at. With that in mind, hey, Michael, I do appreciate all your insight once again on this. Always an interesting topic. We'll be sure to come back and hit you guys with updates as they're happening, because I'm sure there will be plenty just through this year alone, much less in the coming years. So stay tuned to the channel. Make sure you're a subscriber if you're not one already. And also be sure to drop a thumbs up for us, please, if you don't mind. It helps us so much with the algorithm. And until we see you on the next one, Michael, again, thank you so much. And guys, make it a great day and keep on cash flowing. See you soon.